Welcome to Inside the Deal. I'm Mary Kathleen Flynn, and I'm here with Mel Cherney from Scholer. And we're talking about private equity firms who are investing in their own portfolio companies' debt. So why is this an increasing trend now?
Well, really, it's because the market for debt of portfolio companies is so distressed, along with most other asset classes. And the sponsors of the funds that own those portfolio companies think they see value there that the current investors in those loan instruments don't see. And obviously, those sponsors know or think they know more about those companies than anybody else, so they perceive value. The other factor, frankly, is that it's very hard for those sponsors now to buy companies in new deals, given the difficult state of the buyout market, which in turn is caused by the difficult state of the loan market. And so this gives them an opportunity to deploy some of the vast amounts of committed capital that they have sitting on the sidelines that they can't deploy in new deals. It gives them an outlet to deploy it in deals involving companies that they already know a lot about. So those are really the drivers of this increased trend towards buying debt of your own portfolio companies.
What are some of the first steps that the private equity firm would take in terms of looking at its portfolio?
Well, obviously, the first thing you have to do is make sure you're not throwing good money after bad. You almost have to look at it as, as if you didn't have a prior investment. Does it make sense? Would you, as a third-party investor, invest in the debt at these levels? It's easy to get caught up in something you already own and have a bias towards something you already own and think that it's a good investment. You really have to look at it on a clean slate and decide that this company at these prices makes sense. And the return that you're going to earn, if you earn a return, can come in one of two ways. Either the price of the debt will start to recover as the economy starts to recover and or the company starts to do better. Or if things don't turn out as well as you hope, there may be a restructuring of the company. And in fact, what you've ended up doing is buying equity in the restructured company at an attractive price through buying the debt at an attractive price. But the first step obviously has to be to make a close economic analysis of the company's business and make sure that you think that the levels at which you're buying the debt are justified given the company's prospects.
So in the case of a portfolio company's restructuring, how does the private equity sponsor handle it if they've got both debt and equity?
The answer is that in large part, it's often taken out of the private equity sponsor's hands because very often the private equity sponsor is not allowed to vote the debt that he holds, either because the credit agreement prohibits it or as a quid pro quo for allowing the private equity sponsor to buy the debt in the first place, the bank group will insist that he forego voting rights. So it ends up often not being a practical problem.
Let's talk about legislation for a moment. What's happening that's changed and how is it affecting the equation?
In the recent legislation, there's been relief passed so that what would otherwise be cancellation of indebtedness income that you would have to recognize immediately when you buy back your own debt, you can now postpone it to the period from 2014 on. So it allows you, in effect, a 5-year deferral.
All right, thank you very much, Mel Cherney from Scholer.
Thank you, Mary.
And thank you for watching Inside the Deal. I'm Mary Kathleen Flynn.